Hey there everybody, it is Leland the Realtor, and today we are going to compare two fourplexes that had sold in the same exact area, were about the same age, but sold for two drastically different prices. Now I would like to say that when evaluating any rental property at all, you are making a lot of assumptions, and they should be educated guesses on what you think something is going to cost you every single month versus how much money you believe you'll be able to make every single month. There is no perfect science on exactly how to evaluate any rental property. If it were that easy, everybody would do it. So the two fourplexes that we are going to actually evaluate are located in the Chelwood Park area. Now, if you take a look, Chelwood Park is one of the most frequented areas for most investors. And the reason for that is that there are a lot of fourplexes and multiplexes along this road, but then around it are a bunch of single family homes. The reason why this is really important to most investors is that rental properties tend to be graded on what kind of neighborhood they are in and what are they surrounded by. So there are four general categories that most real estate investors use, and that's A, B, C, and D. It's very straightforward. Now, your A-level properties tend to be on the average cost of a home and above. So for Albuquerque, that would be about $230,000 to $250,000 and above that mark. They tend to appreciate in value a little bit more, but don't necessarily cash flow all the time. Often those rents will not exceed how much it costs for you to own the home. So in order to make money on it, you either need to own it for a very long time or you need to sell it within a certain period of time. B-level properties are a little more attractive to most investors because these properties tend to be closer to the median home price. Now that is closer to about $190,000 to $220,000 in Albuquerque, give or take a few percent. And the reason why that's very attractive is that B-level properties tend to both appreciate in value and have a little bit of cash flow on top of that. So it allows you to have a little bit of liquidity, as well as when you sell the property, it will be worth more than what you purchased it for. C-level properties tend to be the most attractive in terms of cash flowing. They tend to be lower priced than surrounding homes, but they tend to cash flow extremely well. They don't appreciate a ton of value. In fact, the only amount that they will appreciate is usually the amount of money you can generate off of the property. But overall, they tend to be really nice for investors because they offer liquidity and consistent cash flow and instant reward today. Then you have your D-level properties. Now, D-level properties, depending on the type of investor that you're looking at, may or may not be attractive. They tend to cash flow extremely well. They cash flow probably better than any other properties available, but you tend to spend more money on maintaining the property, getting tenants in and out, and overall it can be really difficult to maintain these properties and actually cash flow on them because of the amount of maintenance and the type of people living in these properties. They just tend to be a lot more rough on the properties. So the reason why that Chelwood Park Avenue is extremely attractive is because these fourplexes are considered C-type properties in a B-level neighborhood. So they are actually affected by the surrounding neighborhood. They're going to have better quality tenants because there are more single family homes in the area and it's considered a lower crime area, while they still cash flow like C-level properties. So the two properties that we are evaluating were both sold in the same exact area along this stretch of road right here. Now, for simplicity's sake, we're going to call it property A and property B. Property A actually sold for $350,000, and it didn't have substantially higher rents than property B, which sold for $253,000. In fact, both of these properties advertised their rates at about $650 per month per unit. So for both of these fourplexes, the monthly cash collected was close to $2,600 per month. Property A was built in 1977 and was about 3,014 square feet. And property B was built in 1981 and was over 3,100 square feet. So you can see in property A, the price per unit was $87,500. That is extremely high for a fourplex unit in that area. And that is 38% higher than property B, which is priced at $63,200 $250. So let's break down these two properties and why property A was worth $350,000 and property B was worth $253,000. Now, the first thing I really noticed about both of these properties is that the first property was in extremely good condition. It had a brand new roof, it had brand new stucco. The interiors were actually completely redone with the exception to the kitchen. They only painted the counters and then refinished the countertops. But overall, it had a very nice look and feel, and it was much more modern. And then property A was a little bit more dated. It did not have new stucco, did not have a brand new roof. The units clearly had not been updated in the last 10 to 15 years, and overall were a little bit more worn down. But if you were to use the data that was given to you by the listing brokers on these properties, it looks like the $253,000 deal is a much better deal. So let's go ahead and break it down on the computer, and I'll give you an idea of why that property owner decided to spend the $350,000 on a unit instead of the $253,000. Now again, we are making a lot of assumptions, and their numbers may have been very different than mine, but it's best to use your best knowledge of the area to determine exactly what numbers you want to use. So the website that I use for simplicity purposes is biggerpockets.com. If you go into their tools section, they have a rental property calculator, and then you can just start a new report and you get sent to this page just like this. This website is the best for simplicity purposes and is the easiest to interpret, in my opinion. Now, there are other ways to evaluate property and internal rates of return, but that is definitely for another video, which if you'd like to take a look at, once I make it, it'll make a little tag right here in the upper left-hand corner. So we see that property A was purchased for $350,000. Now, I'm gonna assume that they spent about $2,000 in closing costs. So roughly $400 in title fees and probably close to $1,000 in inspections, and then another $500 in the appraisal for the property. And then when we scroll down here, we are gonna assume a 75% loan to value. Now, you are able to adjust this up or down depending on how you like to put your loan to values, but that would give us a loan amount of $262,500. We're assuming an interest rate of 4% because investment properties are not the same as single family homes. You can definitely get a single family home closer to 3%, but because it's an investment property, there's an additional layer of risk, and that 4% is pretty consistent with that additional layer. It may be 4.5, it just depends on your personal situation. And then I'm assuming that whoever purchased this property was charged 1 full percent of the loan value, which means 1% of $262,500. They were probably charged close to $2,600 to originate this loan at 4%. Then of course, I'm choosing a term of 30 years. If we scroll down a little bit more, I actually put the rental income closer to $3,300 a month, which is probably what the evaluator of this property was looking at. Now, the reason I'm using this $3,300 mark is because I'm actually going to assume they are thinking they can get $825 a month for this property, not the $650 a month that was initially advertised. And this is where I got this information. This is actually from rentometer.com. You can type in that address and evaluate any area and what you think the rents are actually going to be. Now, as you can see, I went pretty conservative. This property A was in amazing condition, and I believe that they could probably hit the 75th percentile of rentals in that area. And that would bring it about $860 a month. But I'm assuming that they're only making $825 per month per unit. While property B is probably closer to the $727 per month because it was older and not in nearly the condition of property A. If we scroll down, we can see all the comparables for this property. So over here, it'll show you the actual address of the properties, and it'll show you about how much they rented for. It'll give you the square footage, the 2-bedroom and 1 bathroom. Now, it's important to differentiate the apartments versus the townhouses versus the condos. In fourplexes, you are closer to a condo and apartment and less close to a townhouse. So you can see that these apartments and fourplexes are lower in price, with $826 per month being some of the higher of them, as opposed to these townhouses, which this one is nearly $900 per month. Now, I think this wasn't categorized correctly, but you get the general idea. Assuming that they calculated $825 per month per unit, that brings us to $3,300 per month. Now, beyond that, every year rents go up. Now, just this last year, we saw rents go up, between 13 and 17%, depending on if it was a 2-bedroom or a 1-bedroom, which is not consistent with actual rental rates. It's probably closer to 2 to 3% annual income growth per year. Now, that depends on a lot of factors, but 2% is a very safe and conservative estimate, in my opinion. Now, when I looked at the property taxes from the county assessor's office, it said that the property taxes would be close to $417 per month, and then insurance we're assuming is going to be about $1,200 per year, which is $100 a month. It may be more expensive than that. It just depends on what you think you want in your coverage. Now, with property B, we had a purchase price closer to $253,000. I assumed the same $2,000 in expenses for just purchasing the property. I assumed a 75% loan to value at a 4% interest rate, just like the previous property, and charged 1 point. So their loan would be slightly less expensive than property A's loan. And then I assumed that they are making an income of $29.20 per month. Now, this is closer to the $727 mark. Now, I assumed $730 mark for the properties, which kind of puts us in the bottom 25th percentile. If you can see right here, this is not the property. This is just a property that's in the area we evaluated, just so you know, which is closer to that 25th percentile of properties, which I think is pretty accurate for this one. Now, we also assume the same income growth at 2% for each property. And then the property taxes are going to be substantially less than property A because it is a less expensive property. So that it came out to about $301 a month. And I assumed a same insurance policy or a similar insurance policy. Now, this is where the actual properties really differentiate. You can see so far it's been less expensive to own property B over here on the right in comparison to property A over here on the left. But where we really want to do our calculations is in how much it's going to cost us to hold on to this property above those fixed expenses. So our biggest items that can be very difficult to account for are the repairs, maintenance, the vacancy, and the capital expenditures. Now, repairs and maintenance are your everyday repairs, your everyday maintenance on the property. A light bulb went out, someone put a hole in the wall, or something along those lines, or something as simple as doing a quick repair on the roof itself. Vacancy is how long it's going to be from the time person A leaves to the time person B comes and moves in and starts paying rent. Now, 3% vacancy implies that from the day the first person moves out, we're gonna have about 10 days before the next person moves in, and that's on a yearly basis. So it's not extremely fast, but it's not extremely slow, and 14 days is probably closer to par. Then we have our last item here, which is capital expenditures. That's your brand new roof, that's new water heaters, that's new swamp coolers, that's a new furnace. Those are the items that in your home that are going to break eventually, but they tend to be a lot more expensive, but a lot less frequent. And then of course, management fees. 10% is a very standard management fee. I'm always happy to pay my property manager 10% because she does an amazing job. And I would never hire or pay someone 10% who I didn't feel was extremely competent. So as long as you have a solid property manager, that is going to be probably the biggest key in the difference between a performing property and a non-performing property. A manager that's good to tenants, those tenants are then going to be good to your manager, and that is good to you. So you can see here, I only put in 5% for repairs and maintenance, as opposed to over here on property B, I put 7%. Now, I may be underestimating the 7% repairs and maintenance on this property B, but I think it's a fair valuation of about $2,400 per year that you're going to spend on miscellaneous broken items. while the repairs here are probably going to be more towards keeping your tenants happy and fixing smaller things because your tenants are paying a premium. Now, our next item here is the actual vacancy of the property. Now, like I said earlier, 3% is roughly 10 days in a year. So if you're having 1-year leases signed, that's going to mean that you are calculating on average that you're going to have 10 days of vacancy per unit. So that means in a year, you're going to have a total of 40 days of vacancies because of each individual unit. Now over here, we're assuming a higher vacancy rate because the property is not in quite as good of condition as property A. I would anticipate it's going to take a little bit longer to find the right tenant because the decrease in rent, we're only calculating a $100 difference between these two properties, while property A is in extremely good condition and property B is a little more run down and outdated. A lot of people are willing to spend an extra $100 for an improvement in their living condition. Now over here, we put 5% in capital expenditures. I anticipate that that's going to be really accurate for this property, if not a little bit lower than 5%. And the reason for that is all the capital expenditures have been taken care of for the most part, as opposed to property B, where it's really likely that you probably have a water heater that you need to replace. There's probably going to need to be a newer roof sooner in comparison to property A, as well as, just furnaces breaking, other items. Chances are property B just is a little more run down than property A. And of course, like I said, we're doing 10% for management fees. It's in some cases a little bit higher than that when you calculate in re-rent fees and cleanings, but for the most part, 10% is relatively accurate. Now, just below the repairs, maintenance, property manager, and all those items are the actual utility costs that you're going to incur while you own the property. That can vary wildly depending on the type of tenants you have. I usually notice that most 2-bedroom properties cost me about $50 per month in water and trash, as opposed to a very large home that may have $200 or $300 a month water bill because maybe you water grass or have other water demanding features in the actual property. Now, electricity and gas are going to be for the times that your property is vacant. So you're going to put these units on landlord standby with the gas company and the power company. What that allows you to do is that when the tenant moves out, they automatically switch the utilities into your name until the new tenant comes in. It's something you don't have to worry about actively doing, but you are going to be paying electrical fees and gas fees while owning this property. I think that $40 a month for combined utilities is a pretty conservative estimate, unless of course your property maintains vacant for a very, very long period of time, perhaps during winter where you do not want your pipes to freeze. So after we make those assumptions, we are going to go down here to expense growth and sales expenses. So as we all know, inflation hangs out around 2%. And so I do expect our expenses to grow roughly 2% per year, much like I expect our rents to grow anywhere between 2 and 3% per year. And then below that, we have the actual sales expense of the property. Now, depending on the type of realtor you use, it may be higher than 7.5%, but at a $250,000 property, if you don't make any repairs on that property, 7.5% is probably a pretty accurate number as to how much it's going to cost for you to sell your property. So let's go ahead and update the analysis here. We're going to click this button and this button here. And then we actually see the cash flow per month. This page will actually show you in depth how much money you're going to make based on the assumptions you have made. This is an extremely useful tool. It's extremely easy to read once you get used to it. So let's take a quick look. We see that property A is going to cash flow about $530 per month, while property B is only going to be at $526 a month. So on your cash, or for every $100 that you put into property A, you are going to cash flow $6.91 per year. Now over here on property B, you're going to cash flow per $100 you put into the property $9.41 per year. Now, this is your cash on cash return. So this is the money that you actually put down. It's not the full amount that you paid for the property. It's that 25% down payment and the closing costs that you paid for these properties. So take, for instance, on a $200,000 property, you're gonna pay about $50,000, which is your 25% down payment. Now, cash on cash return is how many dollars you're receiving back versus how many dollars you have put into the property. And that does not include the number of dollars that you received from the bank. So if you were to purchase a property for $200,000 and it required 25% down, at that point you will put $50,000 or 25% of $200,000 of your own money into that property. And then if you made 10% cash on cash return, that means 10% of that $50,000, which would be a $5,000 a year income. Based on just that information or what we see there, we can see that, hey, it looks like property B is a substantially better property to own. But if you scroll down a little bit more, we look at our 5-year annualized return, which is not nearly as big of a difference between property A and property B. Now, that has a lot to do with the resale value of these properties. So my favorite part about the BiggerPockets analysis is that they actually have a 30-year breakdown of how much money you're gonna make at the very, very bottom of the property, of course, with your assumptions in mind. And you can see here, every year, this property, this $350,000 property is going to appreciate. You can see here $7,000 this year, and then you see another $7,000 on year 2, and of course you see 4, 5, 6, year 10. And chances are, of course, that property A is going to appreciate a little bit faster than property B. So if we take into account the appreciation on the property, as well as every single month's rent, at that point, the difference of these two properties is actually less and less. If we look back at this 30-year analysis, you can see at year 5, your return right here is 15.27%, and year 5 here is 16.58%. So you need to determine, is that additional 1% annualized or yearly return worth it for all the headache that property B is going to cause, as well as the risks that you're going to have with that property? Because if you have to purchase an entire new roof for that property, you could end up being out a substantial sum of money. Now, that replacement will increase the value of the property, but will it increase it so much that it'll actually make up for the cost of coming up with that total amount of money, which in this case would probably be close to $20,000. Now, another item that you'll see is that as we get to the 30-year lifespan of these properties, these returns are getting less and less significant and lower. Now, this is why most properties are evaluated on a 5-year basis. Most companies sell their properties about every 5 years. Now, some investors only want to keep their property for a year because maybe they made some improvements to it or rents went up so much that they are able to get rid of the property and make a lot of money up front. While other owners just want to own the property for 30 years, they want the mortgage to be paid off, and they want to retire and make it as easy as possible on themselves. Depending on your personal strategy would depend on how you choose to approach each property and how you would choose to conduct your analysis. Now, the biggest thing that I take into consideration is because property A is in better condition, chances are there's going to be a lot fewer headaches, and the tenants are likely going to be overall better tenants because they're in a nicer property that they enjoy more. That carries with it a lot less risk, which, depending on the situation that you're in, might make a lot of sense to buy property A. Most people who have more money don't want to trade their time for money anymore, so property A would make a lot more sense. While if you don't have quite as much money and you are focused on as fast growth as possible, then property B would likely be your best option. And then the last feature that BiggerPockets offers is an actual PDF download of your property analysis, which you can share with your family, friends, your realtor, your advisor, your mentor, or whoever is assisting you in purchasing this property and making it happen for you. So if you take a quick look, you'll see that normally there's a picture right here, but it is very clear in terms of how much monthly income you expect to get, how much your expenses are going to be, what your monthly cash flow is going to be. And of course, you have your cap rate or your purchase cap rate here. Now, that purchase cap rate for fourplexes is not nearly as relevant as the cash on cash return, because that's what most people are purchasing these properties for. If you scroll down slightly, you'll see all this property information and a bunch of the assumptions we've made. We're assuming that your down payment is $63,250 and your loan fees were $1,897.50. At a 4% interest rate, that would bring your principal and interest monthly payment to $905 a month. Then if you scroll down here, you can actually see all of the breakdown color-coded expenses that you're probably going to have while you own this property. This makes it extremely easy to read and differentiate what is actually going on. And then when you scroll down even more, again, you have that nice 30-year chart of the property and what you anticipate making over the long period of time. There are definitely more sophisticated ways of analyzing properties, and whenever you get into the bigger properties and you get more serious, that is the direction I would go, which would be primarily internal rates of return, actual numbers, and integrating more of your knowledge to bring your assumptions to the table. So I hope you found this video useful. If you did, please share it with your family and friends. Please like this video and subscribe if you haven't already. And again, I am Leland the Realtor, keeping real estate simple. Have a wonderful day.